Okay, we are going to continue our discussion on ways that a company can raise capital. In the previous chapter, the way that we raise capital was by issuing stock. So if a company wanted to raise additional money, they could issue stock, which means they would give away ownership and receive money for that. And if they chose to later on, they could pay dividends. And later on, if they decide to, they can pay dividends, but they are not obligated to. So that is one way to raise capital, by issuing stock like we did in the last chapter. Another way in chapter 14 is to raise capital by issuing bonds. Bonds are different than stock because bonds have to be paid back in full. So bonds is actually a long-term liability, and you will see it on the balance sheet as bonds payable. The way this works is a company issues a bond and the bondholder pays the sum. For example, the bondholder pays $100,000, or let's say the corporation issues a $100,000 bond. And every 6 months, the bondholder receives interest payments. And then, at the end of the bond term, the company will pay the bondholder back the $100,000. So when a company is trying to decide whether to issue bonds or common stock or preferred stock or a combination of those, they will compare and they will look at the scenarios of each. So now we're going to do this. We're going to look at 3 plans and see which one is most beneficial to our company. Okay, and so what we're wanting to get out of this is $4 million. So for all plans, we're wanting the same amount, $4 million. So let's say a company wants to expand and they need $4 million to do that. So the question is, how do I want to get that $4 million? Do I want to issue bonds? Do I want to issue stock, preferred stock, or common stock, or a combination of these? So in plan 1, we're going to issue common stock, the $10 par common stock. Okay, so that is plan 1. Plan 2, we are going to be issuing some preferred and some common. So we're going to do $2 million of preferred and $2 million of common. And remember, this part, they have to give you this part up here. In plan 3, we're going to do $2 million of the bonds, $1 million of the preferred stock, and $1 million of the common stock. Notice that all 3 plans will equal the total of $4 million, the amount that we are trying to raise. When we're trying to determine which plan is beneficial, there are lots of things that we can look at. One of those is how much interest we're going to be paying. We could look at how much the common stockholders will earn per share. We could also look at bottom line net income. In this particular problem, we're going to be looking at earnings per share. So make sure you write this down. Earnings per share, EPS, is calculated as net income minus preferred dividends, all divided by let me see if I can fix this real quick. So to calculate the earnings per share, you need to know that it is calculated as net income minus preferred dividends divided by the number of common shares outstanding. So what this tells is how much they are earning per share of common stock. So it looks very similar to what we did when we calculated dividends per share. But this is going to be net earnings of the company per share. So remember in Plan 1, we were going to issue the stock for $4 million of $10 common stock par. So we're going to put that right here. And that gives us a total of $4 million. All right, in Plan 2, we said we were going to do $2 million of preferred stock and $2 million of common stock to get our total of $4 million. And then in Plan 3, we're going to do our $1 million or $2 million bonds, or $1 million common preferred stock, and our $1 million common stock to get our total of $4 million. So next what we're going to do is calculate our earnings before interest and income tax. This part right here, the earnings before interest and income tax, the problem will have to tell you this number. So in this problem, it is going to be $800,000. This is where things are going to start changing, because look what's next. Deduct interest on bonds. For Plan 1, we don't have bonds, so the interest on bonds would be 0. For Plan 2, we also didn't have any bonds, so the interest in Plan 2 is also 0. Plan 3, we did have bonds. We issued 2 million 12% bonds. So when we calculate this interest, we're going to be looking at it on an annual basis. Since we're looking at net income, it's for a year. So we're going to take our 2 million times our 12% times 1, which you don't have to put 1. So our annual interest expense for these bonds would be $24,000. Okay, let me fix that. Let's just put the formula right here. 2 million times 0.12 is 240,000. So that is $240,000 of interest that we have to pay interest expense to these bond holders. So next we're going to calculate the income before income taxes, and all this is your earnings minus your interest on bonds. Okay, so for this one's easy because it's just going to be 800,000 minus 0, so 800,000. Same thing for this one, 800,000. And then for the last one, it's going to be 800,000 minus $240,000 of bond interest expense. So our income before income taxes will be less in Plan 3. Now we're going to do income tax. The problem will have to tell you what the tax bracket is. So the tax rate given in this particular problem is 40%. Generally, for a corporation, the tax rate will be 35%. And then the general range, or the general amount for most states, is 5%. So we're going to take 800,000 and times it by 40%, so 0.40, and that will give us our income taxes. So multiply each one of the income before income taxes times the tax rate to get your income tax. The reason this one in Plan 3 is less is because we got to reduce our income for income taxes by the amount of the bond interest. So since our Plan 3 we have bonds and we got to deduct the interest expense, our income tax is less. So now we can get our net income. This is net income after bond interest expense and after income tax expense. So let's see what our bottom line net income will be. 800,000 minus 320,000. Same thing here. And then the last one is different because it's less income because of that bond interest expense and less taxes. So next we're going to calculate our dividends on preferred stock. So to calculate our dividends on preferred stock for Plan 1, we didn't have any preferred stock, so we have no dividends on preferred stock. For Plan 2, we have $2 million of 9% $50 par preferred stock. So we need to calculate how much dividends this would be. So remember from Chapter 12, dividends on preferred stock is your number of shares times the percent that they give you, which here it is 9%, times your par value. So here we're given our percent and we're given our par, but we do not have our number of shares. We have the dollar amount, the total dollar amount of the stock, but we do not have the number of shares. So we have to find that first. So the way we get that is we take the 2 million and divide it by your par value, because we only record our stock at par value. So we would say 2 million divided by par. So that means we have 40,000 shares of preferred stock. So now we have all the information we need to calculate the dividends on preferred stock. So we will pick up with that in the second video, because each video can only go to 15 minutes. So stay tuned for part 2.